The spike in yields, yet dollar lower as there's more pressure now on supply. Walk us through what we learned.
Well, there's two aspects to this, Alex. First is for the markets, how much additional supply and of what tenor do they have to absorb? And then for the economy, how much additional debt does all this add up to? Let's take the first question. Here's the auction sizes ahead. They are bang on what analysts had expected, $1 billion more a month in each category, a total of $78 billion. They sold $73 billion in the second quarter. Now we're going to see whether the market can absorb all that, and it looks like there's a little nervousness, particularly at the 30-year size. The Treasury Department says all of these numbers are going to go up $1 billion a month over the current quarter. The issue of the debt is a big one because right now all this adds up to the second biggest borrowing in the second half of the year since the financial crisis, when we had to borrow to finance a lot of government programs. We're going to issue a total of $769 billion in the second half of the year, and that really is starting to add up. Let me take you through a couple charts here, if you can pull these up off of my terminal here. The deficit itself is rising. The forecast by the CBOs will hit $1 trillion by 2020, and the total U.S. marketable debt has been rising significantly over the last year in order to pay for that. Now, what does that mean? Well, you see interest rates rising here as the Fed raises rates, so that means that the government is having to pay more. And you get to this chart here where the deficit is growing, not just because we're spending more, but because we have to pay a lot more in interest. You can see $100 billion extra over the last 5 years in interest as the Fed raises rates and the deficit grows. So this will have a real impact on the economy, and it's one reason economists are looking at this as well as market people.
Yeah, so Mike, this is the part that we might not like as much as we like the big GDP growth, but you get what you pay for. To what extent has the market already priced this in? I mean, we've known for some time about how much money we're going to have to borrow to cover that $1.5 trillion in fiscal stimulus.
Well, it's a process, and it looks like the process is continuing today with a little bit of an adjustment. The strong ADP number suggests the economy is going to continue to grow, and that may add inflationary pressure. And now you have all this supply coming to market. So you're looking at a 10-year that's now threatening 3%. We haven't been there for a couple of months, and analysts are already saying we're probably going to cross that today. We may hold over it as we get ready for what may be a strong jobs report on Friday, and that just raises borrowing across the economy for everyone.